Hi everyone, I'm James Lim from Stewardship Finance Academy. Today we are going to talk about stock market investing. So putting hard-earned money in the stock market can make many people nervous. It is well known that a correction can occur at any time, and the fear of market crashes can make even the most seasoned investors question their decisions. While it's true that putting your money on the line is never easy, the historical record of the stock market is indisputable. Humans have tried over history because of our unique ability to recognize patterns. For example, by discerning how the seasons work and understanding that winter came once every year, humans were able to harness these patterns to successfully grow crops and thrive. We can add on this pattern again and again, and over time it has created massive amounts of food and abundance. Just like the pattern of the seasons, there are clear patterns in financial markets that are evident through many decades of data. So today, we are going to look at some facts and the patterns about the stock market and the market crashes. Understanding these facts, we will be able to prepare for the recurring seasons of the financial market, including the market crash, and it will give you an enormous edge over experienced investors. 200 years of US stock performance. How has the stock market been performing for the last 200 years? Gathering the data from slide charts and the Journal of Financial Markets, we have the total annual returns of US equity returns over almost 200 years. From 1926 to 1956, returns are from the S&P 90, the S&P 500's predecessor. Finally, from 1957 to 2020, returns are based on S&P 500. So the Standard & Poor's 500, or simply the S&P 500, is a stock market index tracking the performance of 500 large companies listed on stock exchanges in the United States. S&P 500 is commonly used to represent the US stock market performance. Historically, the US equity returns have been leaning towards positive performance. Here is how the distribution of returns stack up. There were 3 of the years the market dropped below 30%. They were 1931 during the Great Depressions, 1937, which is known as the Roosevelt recessions, and 2008, the global financial crisis. There were 5 of the years the stock market raised more than 50%. They were 1862, 1879, 1885, 1933, and 1954. Almost 40% of annual returns have fallen within the negative 10% to positive 10% range. From 1825 to 2019, the average total annual return was 9.56%. In fact, over 70% of total annual returns have been positive over the same time frame.
I think those are interesting statistics over there. So it's like over 200 years, only 3 years the returns drop below 30%. So that's actually not too bad, like 3 out of 200. Because like if you compare it to cryptocurrencies, it's like a 30% drop happens so often.
Yes, exactly. So cryptocurrency, we'll talk about it in our future videos. So for this reason, many people, they do not invest because they are so worried about this, like the Great Depressions, for example. But nonetheless, they only happen like what percentage of year within the range of 1.5%. So it's very rare of those incidents. So over this period of time, there have been multiple wars, the worst financial crisis since the Great Depression, dot-com bubble, oil crisis, and many other roadblocks. Despite this, the market is still up. Bear markets become bull markets. John Templeton once said, the best opportunities come in times of maximum pessimism. Due to the cyclical nature of the economy, recessions tend to be followed by strong recoveries. So once the bear market ends, the following 12 months can see crucial market gains. The market has always risen despite short-term setbacks. In 1957, the year the S&P 500 was created, the stock market saw a loss of almost 11%. Stock prices shot up by over 43% the following year. The 2008 global financial crisis led to one of the largest equity losses to date. In 2009, stocks climbed by almost 27%, boosted by expectation of higher capital spending and demand as the economy recovers.
So I think from this chart, we can see that after a crash year, then immediately the following year usually is recovered already. Just need to wait 1 year to see the positive gain again.
Yeah. So for this reason, we advise our students to not sell their stock so that you will not miss the next year bull market. On average, corrections happens once per year. Correction means a decline of 10% or more, but not more than 20%. For more than a century, the market has seen close to one correction per year. In other words, corrections are a regular part of financial seasons, and you can expect to see as many corrections as birthdays throughout your life. The average correction looks something like this: 54 days long, 13.5% market decline, and occurs once per year. The uncertainty of a correction can prompt people to make big mistakes, but in reality, most corrections are over before you know it. So if you hold on tight, it's likely the storm will pass. Fewer than 20% of all corrections turn into bear market. A bear market is a prolonged period of price declines in the stock or entire market, so usually of 20% or more from a recent high. When the stock market starts tumbling, it can be tempting to abandon ship by selling assets and moving into cash. However, doing so could be a big mistake. You would likely to be selling all of your assets at a low right before the market rebounds. Why? Because fewer than 20% of corrections turn into bear markets. Put another way, 80% of corrections are just short breaks in the bull markets, meaning that if you sell early, you will miss the rest of the upward trend. How about the bear markets? Historically, bear markets have happened every 3 to 5 years. But bear markets don't last. According to an analysis by First Trust Advisors based on data from Bloomberg, in the 75-year span between 1947 and 2022, there have been 14 bear markets, ranging in length from 1 month to 1.7 years. So on average, they lasted about a year. And in severity from 20.6% to 51.9% in the S&P 500. However, the average bull market period lasted 4.4 years with an average cumulative total return of 154.9%. So the bull market usually lasts longer with higher return.
So in this case, we shouldn't just exit during a bear market. Is that what you would say? That we should tide it through, wait for the next recovery, because the market should always recover, right?
Yes. So unless you do need the money for anything important for your life, or else that is seen you do not need to use that money for anything, that is best to hold on. And then later on, I'll give you an even better reason why that you should hold on to it. So the question that we often receive is there a best time to buy stocks? So many investors believe that equity markets perform better during certain times of the year. Is there any truth to these claims, or is it superstitious nonsense? We can investigate the data gathered by Desk, a British asset management firm, to investigate. This analysis is based on 31 years of performance across 4 major stock indexes: FTSE 100, an index of the top 100 companies on the London Stock Exchange; MSCI World, an index of over 1,000 large and mid-cap companies within developed markets; S&P 500, an index of the 500 largest companies that trade on US stock exchanges; Euro Stocks 50, an index of the top 50 blue chip stocks within the Eurozone region. The data shows the historical frequency of these indexes rising in a given month presented in percentage between the years 1987 and 2018. There are some outliers in the data set that we will focus on. In terms of frequency of growth, December has historically been the best month to own stocks. The frequency of growth is 79%, so 19.9% higher than the mean. This lines up with a phenomenon known as the Santa Claus rally, which suggests that equity markets rally over Christmas. So one theory is that the holiday season has a psychological effect on investors, driving them to buy rather than sell.
Is it like because they are in a joyous season, so
Yeah, when people happy, they tend to spend more money. Yes, when they are in the buying spree, it's a season of buys. You know, the buy style, you buy gifts, shopping around, so including people will tend to buy more stock as well.
So like the stock market is somewhat driven by emotions in a way.
Yeah, definitely. So human psychological effect are the one that affect the market prices as well. Yeah. We can also suppose that many institutional investors are on vacation during this time. So this could give bullish retail investors more control over the direction of the market. So the second best month was April, which is commonly regarded as a strong month for the stock market. The frequency of growth is 74.3%, so 15.2% higher than the mean. So one theory is that many investors receive their tax returns in April, which they then use to buy stocks. So the resulting influx of cash will then push the price higher. So how about the weak months? The 3 worst months to own stock according to this analysis are June, August, and September. Is it a coincidence that they are all in summer? So one theory for the season's relative weakness is that institutional traders are on vacation, similar to December, but without the holiday cheer, the market is less frothy and the reduced liquidity leads to increased risk. So whether you believe this or not, the data does show a convincing pattern. It is for this reason that the phrase "sell in May and go away" has become popularized. So Suguan, do you know why we keep encouraging our students to have a long-term perspective when they come to stock investments?
Because I think it's better to just stay invested instead of like going in and out, and you might not know when would be the right time to enter again.
Exactly. And also, because the US stock market has never lost money over any 20-year period, US markets have consistently performed over long holiday periods, even going back to the 19th century. So the measure of a plan puts together a set of data shows the performance of the US market over different rolling time horizons using annualized return. So taking a 1-year view, we see lots of red. There were plenty of years in which the market was down. Unfortunately, if you were to just choose a 1-year period at random, there would be a significant chance of losing money. Over 146 years of data, the chance of seeing negative returns for any given year is about 31%. However, as the time frames get longer, going to 5-year, 10-year, and then 20-year rolling periods, the frequency of losses rapidly decreases. By the time you get to the 20-year windows, there isn't a single instant in which the market had a negative return. So the US stock market has never lost money over any 20-year period. So if you invest in the stock market for 20 years, the maximum annualized return is 13.2% and the minimum annualized return is 0.5%. So long-term investors can see that as long as your time horizon is measured in decades, your odds of making money in the stock market is as secure as putting money in the bank.
So compared to bank, it is secure, but you still stand to gain the upside returns of stocks compared to just putting your money in fixed deposits, right?
Yes.
So the returns much more than cover the risk if you hold for a long term.
Yeah. So nowadays, how much we get? A lot of countries now less than 2%. Putting a stock market, you can reach as high as 13.2% for over 20 years period of time.
It's very attractive.
So Warren Buffett put it best. The stock market is a device for transferring money from the impatient to the patients. So a study by Schwab Center for Financial Research is perhaps the most eye-opening of all. Let's say you had $2,000 of cash to invest each year for 20 years, starting 2001 to 2020. If you invested at the best moment of each year, which means that with perfect timing, you will end up with $151,391 by the end of the 2 decades. If you invested in treasury bills, so which means you stay out of the stock market completely, put your money in cash, you will finish with $44,438. Okay, now here is the kicker. If you were the unluckiest person alive and invested at the worst time each year, how would you do, right? You will still finish with $121,171, which is way better than cash and almost as good as having perfect timing. So that is why Tony Robbins says the biggest danger isn't a correction of a bear market, it is being out of the market.
When you say like bad timing, do you mean like even if the person put in the money just right before the market crash, he will still make money as long as he still remain invested in the market?
Yes. So this analysis look into different way of investing. Perfect timing being that you invest every time at the market bottom, right? Invest immediately, basically as soon as you get your pay. As soon as you get your paycheck, you invest. Dollar cost averaging, you just put in a fixed amount of money at fixed time in a month, for example, right? Bad timing, like what you say, you invest in at the market top. Yeah. So based on this, you can see the results are still much better than if you stay your money in the treasury or in the cash.
That's really a big difference between cash and stock market investments.
Yeah, certainly.